Great. Thanks a lot, Nikolai and Peter and Ramiro and also to ABEARS for inviting me to speak today on this topic, one that we just covered ourselves back in the United States and touched on a lot of these same themes. In fact, a lot of the discussion, I just listening to Peter go through his presentation, are a lot of the same things that we've been talking about for the U.S. outlook, and I'll talk a little bit about that, and I'll touch on some of the trade themes as well as our new Farm Bill, which I know has generally generates quite a bit of discussion and interest, both within the United States and outside. But again, just to start with, one of the things we do in the Office of the Chief Economist at USDA is we put out our monthly forecasts for global supply and demand. And this is one of the charts that we put up last year, we used last year in trying to understand wheat production for last year here in Australia, just highlighting the different, larger percentage-wise areas for production in Australia, and then also matching this up with climatological data to get estimates on what yields and production might be. And that's something that we can certainly talk about some more during the coffee break. Moving on to just the outlook, I'll start with macroeconomy. This just shows that in general, we're expecting a slightly slower global economic growth over the next several years. Between now and 2020, this essentially translates into roughly $700 billion less in purchasing power, and a lot of that will be concentrated in developing countries. So again, while we look to the developing and emerging economies to generate a lot of the demand for our exports, we do know this is slightly lower, and that is partially a China story in the sense that Chinese economic growth is expected to slow as well. And of course, for Australia, that obviously poses some interesting questions due to the fact that Australia's economy is closely tied to the Chinese growth as well. I'll just go on to currency now. Of course, economic growth often generates changes in currency, and what we've seen over the last several years, in fact, since I would say the 2010-2009 recession in the United States, that the US dollar has generally been appreciating relative to other currencies. And we've seen that particularly in the first 3 quarters of last year, and this will weigh on our potential to export against the competition that Peter just mentioned. Generally speaking, our producers are very competitive, but when you have these appreciations in the dollar relative to other currencies, it makes our competitors have a little bit of advantage regarding international trade. Of course, we've seen the Australian dollar, as I mentioned, also being tied closely to the health of the Chinese economy. China is obviously Australia's largest export market in agriculture, iron ore, coal, and copper. And certainly the U.S.-China trade conflict right now threatens to slow an already slowing Chinese economy, which will have repercussions for Australia's economy as well. Certainly we would expect that if there is a deal reached between China and the United States, that will benefit the Australian dollar and the Australian economy. Here in Australia, just as you know, the high household debt, a lot of that has been fueled through real estate appreciation here in Australia, has begun to slow consumer spending, and that in combination with the weakness in China has prompted the Reserve Bank of Australia to keep its policy interest rates at record low levels, again benefiting economic activity and exports. Turning to major factors influencing the crops for 2019, we just put out our new crop year estimates in the United States. In addition, we're putting out our 10-year estimates, which mirror the presentation that Peter just gave. Looking at this coming year and then out over the next 10 years, we see some tightening in stocks, particularly in wheat and corn this past year. Obviously not the same situation with respect to soybeans. We saw a building of soybean stocks measured in use. And this is global in days of use for demand. Over the next decade, we do expect to see tightening conditions, and that should prop up prices for corn and soybeans in particular, where we expect global consumption growth to outpace supplies and support prices. Although I would say that our long-term forecast is also showing over the next 10 years, while we do see some nominal growth in prices. In real terms, we would expect those to be relatively flat, potentially declining. And that also would play into our economic story with respect to farm income as well, which I'll get to towards the end of the presentation. So just looking at the upcoming forecast, we do see expanding global stocks of wheat and soybeans, again for soybeans primarily in the U.S., not necessarily for the world markets, and tightening supplies of corn stocks. And what will that do? Our forecasts right now extend the expectation of the tariff situation with China certainly through the 2019 and 2020 year, but also through the 10-year forecast. So a lot of the numbers I'm presenting today would change under a trade agreement. But assuming that we maintain the current tariff situation with China, we would expect soybean prices to rise slightly, about 2.3% to about $300 per metric ton as the market in the United States begins this multi-year process of working down at the large stocks that we've built up this past year. Alternatively, we expect corn to appreciate slightly, corn prices on the farm up about 1.4% to $134 a ton. That's the second year of price increases, and we're actually sitting at almost a 5-year high right now for corn prices. Continued trade with China is expected to allow for success in our ability to export corn as it hampers our export opportunities for soybeans. In the wheat markets, we expect a slight increase in prices, about 1% in this coming year to $191 a ton. That's risen significantly, though, I'll point out, since we hit bottom several years ago. And cotton prices down almost 7%, but coming on top of recent high prices that we've seen relatively. So looking to plantings, so we've got a large overhang in the soybean stocks in the United States, and of course producers are looking at that, and they're going to start to work down those record high soybean carrying stocks. Soybean area in the United States is expected to fall almost 5% in 2019 to 34.4 million hectares. Corn expected to be the primary beneficiary of that area, increasing about 3% to 37 million hectares, and that's the largest since the 2016 planting season. Again, at that point in time, the price ratio was much more favorable to corn than it is right now. We did expect to see more wheat acres going in the United States, but last fall we had pretty terrible planting conditions in a lot of the winter wheat acres. So we are expecting at this point to see a decline in wheat acres, down slightly. In cotton area, and that'll be picked up by a variety of things, maybe some sorghum, maybe some additional soybeans, in fact. Cotton area is expected to increase modestly, about 1% up to 5.8 million hectares. And that's despite that recent softening in prices that I just showed. We have relative returns to other crops in the area are improving, and particularly with respect to soybeans or peanuts. And we've also seen fairly good soil moisture content right now in a lot of the planting areas. So we do expect to see record high production in cotton, which I'll get to here. So just assuming normal weather patterns for the United States, of course, we do see drought or excessive moisture often, but just, of course, with our early estimates, we assume normal weather. We should boost our corn harvest to near record highs at 378 million metric tons. Soybean production with that loss in acreage should fall 8% to 114 million metric tons. Wheat production should increase slightly. Of course, all of these assume some increase in productivity. Just normal productivity trends are assumed here. And of course, last year we were coming off a record production in some of these commodities. So again, assuming normal weather, but increasing productivity is leading to our estimates here. Overall, cotton production should be a 5-year high at 4.9 million metric tons in 2019. So I'm going to turn here to livestock and dairy. The outlook for livestock and dairy is for continued record production. Though prices for livestock, poultry, and milk did decline in 2016, lower feed prices provided the impetus for expansion of flocks and herds at that time, and cattle has benefited also from improved forage supplies through much of the year. In the case of hogs and turkeys, further support for growth reflects recovery from the disease outbreaks in the United States, which affected hog production in 2014 and turkey production in 2015. So we're still in this herd building sense, both from disease but also from poor drought conditions that we had in the United States roughly between 2010 and 2014. As Peter mentioned, we're nearing the height of our cattle cycle in the U.S. Now we know that, of course, prices are going to be affected by a number of things in addition to just normal production. We've seen significant outbreaks of African swine fever throughout many provinces in China. Of course, it's a highly contagious disease to pigs, but no threat to humans. But certainly there are no vaccines available right now. China, we know, has the largest pig herd of 400 million pigs, about half the world's supply. So any significant outbreak in China is going to affect, and certainly they've got the highest per capita consumption of pork as well. Further spread in China would lead to significant culling and reduction of China's pork production, and that may in part explain why we did see this movement in futures prices for hogs in the United States recently. I'm showing here we saw, when we put in the retaliatory our 232 tariffs and then China responded with their retaliation, we did see futures prices for hogs in the United States tumble very quickly. And then we had an announcement of the outbreak of African swine fever in China, and we saw quite a big response in futures markets in the United States. Now, as we've been tracking that, and at the same time, the farrowing intentions in the United States have been growing, so producers in the United States have been indicating that they're planning on bringing more pigs to market. And we've seen since that point in time, even though there is this worry out there, this risk of substantial disruption in global pork supply, that at least in the United States right now, the market is pricing in lower returns to pork production. So again, just turning to production, prices. Expansion of the dairy, cattle, hog, and broiler production at the end of the drought. High feed prices have generally been depressing prices for U.S. animals since 2014. So we've seen declining prices since the records we saw at the end of the drought period in the United States. Well, growth in production will likely continue. We see a mixed output for prices this year, as Peter had shown as well. Fed steer prices are expected to settle at about $2.30 per kilo, up slightly about 1.2% year over year, supported by solid demand. Domestic demand is rising in the United States. Per capita consumption of beef is increasing. Hog prices expected to decline slightly, down about 7.5% from last year. And that's again under the weight of the large number of hogs expected to come into market and a continued expansion in production. Broiler prices have recovered in 2018, but expected to settle pretty much unchanged at $1.90 per kilo as production is expanding modestly. We are expecting strengthening milk prices in 2019. Our all milk price expected to rise about 6.5% this year, and rising faster than feed costs are expected to rise. So we do expect improvement in the sort of dairy economic margin modestly in 2019, which will be a relief because we've seen a lot of the same story that Peter was talking about just recently on the dairy herd here in Australia. So in terms of production, this is a story that I've been telling over the last couple of years. We continue to expect record production. Total meat and poultry production likely to hit about 105 billion pounds in 2019 as production of beef, pork, and broilers all increase. Now, I don't know if I put that in metric tons here. Yeah, total of 47.5 million metric tons in meat production, and then almost 100 million metric tons in dairy production. The rate of growth in pork production in the near term reflects the demand for slaughter hogs due to increases in capacity. We've been building out slaughter capacity in the United States. And continued growth reflects also increasing gains per pig per litter, so productivity is increasing, and consumption is increasing, up 4.5% in domestic per capita consumption, and expecting also to increase export supply. Broiler production expected to rise as the broiler feed price ratio improves, supporting solid returns and steady growth of the sector. And milk production, as I mentioned, expected to respond by producing 220 billion pounds of milk, modest dairy herd expansion to more than 9.4 million cows, and growth in milk per cow. All right, turning to trade, and this is a slide that I put in here for Ramiro's benefit. I was visiting Argentina last year and took this picture of a Chinese COFCO terminal filling up a ship with Argentinian soybeans. So we expect, certainly with the condition that we've seen in the tariff relationship with China, to see a very large decline in the amount of U.S. ag products that are shipped to China. Again, this is under the assumption of continuation of tariffs. Overall, we forecast ag exports out of the United States at $141.5 billion in fiscal 2019, and that's down about $2 billion from last year. The share of U.S. exports to China is expected to be 6%, and that's down sharply. That's that yellow line there that shows percent of our exports going to China. Soybeans, the largest sector affected by the current situation, takes up the largest share of that decline. Excuse me. And despite the rising trade tensions, we do expect corn and wheat exports to hold strong, along with increase in horticultural product exports. Products up slightly at $35 billion. Livestock and dairy poultry exports are expected slightly down, $130 million. Globally, Globally, over the next 10 years, we do expect to see increase in global trade. Wheat trade up, we expect by about 17.6% over the next 10 years, reaching almost 217 million metric tons by 2028. Coarse grain trade also up by about 20%. Of that, corn trade is expected to comprise about 80% of that. Barley share expected to increase slightly to 14.7%. Global soybean trade expected to increase by 23.4% during the projection period, reaching nearly 200 million metric tons by 2028. Of that, China's soybean import accounts for 76% of the increase. Consumption of poultry meat is expected to rise at about 1.9% annually. Global pork consumption growth is slightly stronger than beef at an annual rate of 1.2%, and just about 1% annually for beef, continued beef consumption increases that are supplied by increased trade. 3 countries, China, Brazil, and India, account for more than a third of the increase in global meat consumption by 2028. The large and growing population and incomes of these countries significantly contribute to the large increases in that meat consumption demand. Looking at China, so again, we put these estimates together back in October, November period last year. A lot has happened since then, so we've adjusted them slightly, but I think the story still holds that under these retaliatory tariffs, we expect China's soybean imports to still rise, but not quite as fast as we had it projected last year, rising 32.1 million metric tons over the next 10 years. Brazil and Argentina, with combined projected growth of exports of 27 million metric tons in that period, may meet most of China's growing demand for soybeans of the increase. China's sorghum imports are expected to remain steady at about 2 million metric tons annually through 2028, in contrast to our previous projection of growth from 5 million to almost 7 million metric tons last year. China's imports of barley, used largely as a feed grain in place of corn and sorghum, are projected to rise from 9.5 million metric tons to 12 million metric tons in 2028. And of course, China is expected to be the top importer of pork and beef in 2028, up to 2 million metric tons and additional both pork and beef imports. However, in the case of wheat, our projection in 2019 is higher than it was in 2018, boosting China's wheat demand. Despite having a wheat surplus, import demand remains strong due to a deficit of wheat suitable for use in baking and specialty products. So that may be a market that Australia is able to capture. Again, it's really hard to forecast China, and I don't need to tell you that. I don't need to tell. It's something that we grapple with every year. I can show charts over the last couple of years of how much our projections have varied. But of course, China domestic corn prices have been well above global prices, and that has led to a variety of strategies used by the Chinese feed sector, whether it's turning to DDGs and then turning to barley and sorghum. it makes it difficult, certainly, for producers to plan for in the coming year. Overall, though, I think the story from a global food security perspective is good. We expect improved global GDP over the next 10 years to improve purchasing power for consumers in many developing countries. And we would expect that productivity and production growth will keep pace or exceed demand over the next 10 years, resulting in overall declines in prices for most agricultural commodities. And together, that should alleviate the number of food insecure in the planet by nearly 336 million people by 2028, lowering the percentage of the food insecure from about 20% to 10%. So again, overall, a very positive outlook for the world's food security situation. I'm going to talk real briefly about U.S. farm policy. I think I'm doing okay for time. I'm almost done, and then we can answer any questions you might have during the question and answer or over a coffee outside. So again, this is a similar story as to what Peter just mentioned for Australia. We have seen the downturn in net farm income. I'm talking about net farm income here, and this isn't gross farm income, so it's a little bit of a different metric. But over the last several years, we've seen quite a large decline in the U.S. Farm income, falling from net farm income from $134 billion in 2013 in real terms to the forecast of 2018 of $66 billion. Now we do expect net farm income to go up in 2019, and we're putting out that new forecast in several days now. But the 2018 forecast for net farm income is about 16% below the long-run average, whereas net farm income in 2013 was 70% above that average. So farmers in the United States have seen quite a dramatic fall in their profitability. Now you'd think that would show up in equity, but we have seen very strong land values remain in the United States, and that's kept farm equity near record levels over the last several years, since 2013 in particular. And that has helped farmers weather a lot of this downturn as they start borrowing against that equity. So again, these are some of the situations that U.S. legislators were thinking about when they crafted the new Farm Bill. Another thing that they're thinking about was just generally long-term trends in farm policy in the United States. We've seen a movement away from farm programs that have told farmers how much and what they could produce to more of a risk mitigation type of strategy. So crop insurance has become a larger part of the Farm Bill. So there's premium subsidies for purchasing crop insurance. So we've seen a large uptake in crop insurance over the last 10 years. And that's contributing, taking away from a lot of the former direct farm program payments that we had in the past. We have seen some changes in emergency payments as well to deal with some of the hurricanes that we've had in the United States over the last couple of years. So we've had wildfires and hurricanes in 2017 and 2018, and we have seen those programs also. Those are more ad hoc, though, and less part of the Farm Bill. Overall spending in the Farm Bill, and this is a 5-year, our Farm Bills are put in place for 5 years. So this will cover the 2018 to 2023 period. And generally speaking, most of our Farm Bill of about the change in the Farm Bill this year is about $400 million. The total is about $326 billion over 5 years, of which 76% is for food assistance in the United States, about 9% is for crop insurance, and about 77% is for commodity and conservation payments. And I'll just conclude with a couple comments, and I apologize, I'm going to have to turn my back on here and read from the screen because it's a little hard for me to read down there. But generally, we see global economic growth slowing slightly. That's going to crimp export demand. We do expect export demand to continue to grow, but at a slower rate than we saw previously. In the United States in particular, due to the trade situation, we've seen a huge buildup of soybean stocks. Right now, our stocks-to-use ratio in the United States is at 23%. It was about 10% prior to the tariff situation. And so we're going to plant fewer soybean acres, and what's going to benefit are corn acres. So U.S. producers are likely to plant about 3% more corn acres in the United States. We expect record meat and dairy production, slight improvement in expectation for prices. In particular, for the dairy sector, we expect dairy margins to improve this coming year. Overall, ag exports are down in the United States by about $2 billion in 2019. And in particular, sales to China are expected to fall this coming year. Overall, though, I would say certainly U.S. Producers are concerned about the situation with China, but it is certainly speaks to the ability for U.S. producers to find new markets. We have maintained exports at over $140 billion, despite the fact that we've lost a lot of that Chinese market. So I know that going forward, we're certainly aggressively pursuing opportunities to sell into other markets as well as to reach trade agreements. So we can talk a little bit more about that during the break. Overall, which should also be beneficial for Australian producers, we see continued growth in Chinese import demand, and higher for wheat than we had last year, but also certainly in oilseeds as well. Meat and dairy demand from China as well as other developing countries is expected to continue to grow. So with that, I'll stop and thank you for questions in the next period. Thanks.